quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. Most people come into trading with the same expectation that making money is simply a matter of learning a strategy. They believe that once they find the right setup, the right indicator, or the right entry signal, everything will fall into place. And yet, the reality is brutally different. The vast majority of beginners lose money, and they lose it consistently. Not because they are unintelligent, not because they lack effort, but because they fundamentally misunderstand what trading actually is. Trading is not a game of predictions. It is not about being right. It is not about finding certainty. It is a probabilistic business where uncertainty is constant, and the only thing that matters is how you manage that uncertainty over time. Beginners step into the market expecting clarity, but instead they are faced with randomness, noise, and emotional pressure. And without a structured framework to navigate that environment, they default to instinct, and instinct is exactly what leads them to losses. This is where most traders get it wrong. They try to win trades instead of trying to build a process. They focus on outcomes instead of decisions. And because of that, they end up chasing the market, reacting emotionally, and repeating the same mistakes over and over again. In this video, the goal is simple: to show exactly how beginners lose money, not in vague terms, but in precise, repeatable patterns. And more importantly, to show how those patterns can be avoided. Because once you understand the mechanisms behind losing, you begin to see that profitability is not about doing more. It is about eliminating what does not work. By the end of this, you will not just understand why beginners fail. You'll recognize those behaviors in real time within your own decision making, and you will have the framework to replace them with disciplined, professional execution. There is a common assumption that losing in trading is random, that it is simply part of the learning curve and cannot be controlled. But in reality, beginner losses are highly predictable. They follow clear behavioral patterns that repeat across almost every new trader. Once you see these patterns, it becomes obvious that losses are not accidental. They are the result of specific decisions made under pressure without structure. One of the first things to understand is that the market does not cause beginners to lose money. The market is neutral. It simply moves based on liquidity, macroeconomic forces, and participant behavior. The losses come from how beginners interact with that environment. And more often than not, that interaction is reactive rather than deliberate. Beginners tend to enter trades without a defined edge. They rely on isolated signals, random pieces of information, or short-term price movements that appear meaningful but are not grounded in any consistent logic. This creates a situation where every trade is effectively a gamble, even if it feels calculated in the moment. At the same time, there is usually no structured approach to risk. Position sizes are inconsistent. Stop losses are either too tight, too wide, or not used at all. And because of that, a small number of losses can quickly erase a large portion of the account. The issue is not just losing trades, it is the way losses are handled. This is where the foundation of failure is built. Not in one catastrophic decision, but in a series of small, undisciplined actions that compound over time. And unless these behaviors are identified and corrected, they will continue regardless of how much knowledge or strategy is added on top. One of the most damaging habits beginners develop is the need to be right. It sounds harmless on the surface, but it is one of the fastest ways to lose money in trading. Because when the objective becomes being right, instead of managing risk, decision making becomes emotionally driven rather than logically structured. When a trade moves against a beginner, the natural response is not to accept the loss. Instead, there is a tendency to hold on, to hope, to convince oneself that the market will turn. Losses are avoided, not by exiting the trade, but by delaying the realization of that loss, and in many cases, this leads to even larger losses. This behavior is reinforced by occasional outcomes where holding a losing trade does eventually work. The market may reverse, the trade may return to profit, and this creates a dangerous belief that patience is always the solution. But in reality, this is not patience, it is a lack of discipline, disguised as conviction. Professional traders think differently. They do not measure success by whether a trade wins or loses. They measure success by whether the trade was executed according to plan. If a loss occurs within the rules of the system, it is considered a correct decision. Beginners, on the other hand, often do the opposite. They judge decisions purely by outcome, which leads to reinforcing bad behavior when it happens to produce a positive result. Over time, this creates a cycle. Losses are avoided until they become too large to ignore, and wins are taken too quickly out of fear of losing them. The result is a negative risk-reward structure that makes long-term profitability almost impossible. Another consistent pattern among beginners is overtrading. There is a belief that more trades mean more opportunities, and therefore more chances to make money. But in reality, the opposite is true. The more frequently you trade without a defined edge, the more you expose yourself to randomness and the faster losses accumulate. Overtrading is often driven by boredom, impatience, or the need to feel productive. Sitting out of the market feels uncomfortable, especially when there is a constant stream of price movement. Beginners feel as though they are missing out, as though every movement is an opportunity that must be captured. This creates a compulsion to act even when there is no clear reason to do so. The issue here is not just the number of trades, but the quality of those trades. Without strict criteria for entry, every decision becomes subjective. And subjective decisions are heavily influenced by emotion, recent outcomes, and external noise. This leads to inconsistent execution and unpredictable results. Professional traders approach this very differently. They understand that trading is not about activity, it is about selectivity. The goal is not to trade more, but to trade better. This means waiting for conditions that align with a defined strategy, even if that means taking very few trades over a given period. Beginners often struggle with this because it feels counterintuitive. Doing less feels like falling behind, but in trading, restraint is not weakness, it is a core component of discipline, and without it, consistency cannot be achieved. A critical mistake that accelerates losses for beginners is poor risk management. This is not just about how much is risk per trade, but how risk is understood in the first place. Most beginners focus almost entirely on potential profit while giving very little attention to potential loss. And that imbalance is what ultimately leads to account damage. When entering a trade, the first question should never be how much can be made, it should be how much can be lost, and whether that loss is acceptable within the context of the overall account. Beginners often reverse this thinking. They see a potential opportunity, imagine the upside, and then adjust their position size or stop loss in a way that supports that expectation. This leads to inconsistent risk exposure. Some trades may be small, others disproportionately large, depending on confidence levels rather than structured rules. And because losses are inevitable in trading, this inconsistency ensures that a few poorly managed trades can outweigh many smaller gains. There is also a tendency to move stop losses once a trade is live. When price approaches the stop level, beginners often shift it further away, hoping to avoid being taken out. But this does not reduce risk, it increases it. It transforms a predefined loss into an undefined one, removing the only layer of protection that exists. Risk management is not optional in trading. It is the mechanism that keeps you in the game long enough to develop skill, Without it, even a good strategy will fail. And this is where the separation begins. Beginners treat risk as an afterthought, while professionals build everything around it. Another way beginners consistently lose money is by misunderstanding what a trading strategy actually is. There is a tendency to believe that a strategy is simply an entry signal, a specific pattern, indicator, or condition that tells you when to buy or sell. But a real strategy is far more comprehensive than that. It is a complete framework that defines not just entries, but exits, risk parameters, trade management, and the conditions under which no trade should be taken at all. When beginners focus only on entries, they create an incomplete system. They may occasionally enter at the right time, but without structured rules for managing the trade, the outcome becomes inconsistent. A good entry can still lead to a loss if it is managed poorly, and a mediocre entry can still be profitable if it is handled with discipline. The entry alone does not determine the result. This is where confusion begins. Beginners often switch strategies frequently, believing that the issue lies in the setup itself. They move from one approach to another, constantly searching for something that produces immediate results. But the real issue is not the strategy, it is the lack of a complete process around it. Professional traders do not think in terms of isolated signals, they think in terms of systems. Every action is predefined, every scenario has a response. There is no ambiguity once a trade is entered, because the decision making has already been done in advance. This removes emotional interference and creates consistency over time. Without this structure, beginners are forced to make decisions in real time, under pressure with money at risk, and in that environment, even simple decisions become difficult. The result is hesitation, second guessing, and inconsistency, all of which contribute directly to losses. A major driver of beginner losses is the inability to think in probabilities. Most people naturally think in terms of certainty. They want to know whether a trade will win or lose before they take it. And when that certainty is not available, they either hesitate or overcommit based on emotion. Trading does not offer certainty. Every trade is uncertain, no matter how strong the setup appears. The goal is not to predict the outcome of a single trade, but to operate within a system that produces a positive outcome over a large number of trades. This requires a complete shift in mindset. Beginners often struggle with this because they evaluate each trade individually. A losing trade is seen as failure and a winning trade is seen as success. But this perspective is flawed. A single trade means very little in isolation. What matters is the distribution of outcomes over time. When you think in probabilities, losses are expected. They are part of the process. There is no need to avoid them, only to control them. Wins are not something to chase, but something that emerges naturally when the system is applied consistently. This shift in thinking changes everything. It removes the emotional attachment to individual trades and replaces it with a focus on execution. The question is no longer will this trade work, but does this trade meet my criteria? And that distinction is what separates reactive trading from professional trading. Emotional decision making is another key reason beginners lose money, and it often operates in subtle ways that are not immediately obvious. Fear and greed are the most commonly discussed emotions, but beneath them are more nuanced psychological drivers such as the need for validation, the fear of missing out, and the discomfort of uncertainty. Fear tends to manifest in hesitation and premature exits. A beginner may enter a trade correctly, but as soon as the market moves slightly against them, doubt begins to build. This leads to exiting too early, often just before the trade moves in the intended direction. Over time, this behavior reduces the average win size, making it difficult to offset losses. Greed, on the other hand, often leads to holding winning trades for too long or increasing position size beyond acceptable limits. The desire to maximize profit overrides the original plan, and risk is increased in ways that are not justified by the strategy. Then there is the fear of missing out. This drives impulsive entries, where trades are taken not because they meet criteria, but because the market is moving and there is a sense that an opportunity is being lost. These trades are typically low quality and contribute significantly to overall losses. Professional traders are not free from emotion. The difference is that their decisions are not controlled by it. Their processes are designed to operate independently of how they feel in the moment, and this is achieved through structure, repetition, and strict adherence to predefined rules. Another common issue is the lack of patience in allowing an edge to play out. Even when beginners have a strategy that could be profitable, they often fail to execute it consistently over a sufficient number of trades. Instead, they abandon it after a small series of losses, assuming that it no longer works. This behavior is rooted in a misunderstanding of variance. In any probabilistic system, outcomes are not evenly distributed. Losses can cluster together even within a profitable strategy. Without an understanding of this, beginners interpret normal drawdowns as evidence of failure. As a result, they begin to modify the strategy, skip trades, or switch approaches entirely. This constant change prevents them from ever seeing the true performance of the system. It also introduces inconsistency, which makes it impossible to evaluate what is actually working. Professional traders expect variance. They understand that a strategy must be executed over a large sample size before any meaningful conclusions can be drawn. They do not react to short-term outcomes because they know those outcomes are not representative of the overall edge. Patience in trading is not passive. It is an active decision to follow a process, even when the results are temporarily unfavorable. And without that patience, even a strong strategy will fail in the hands of an undisciplined trader. Finally, one of the most overlooked reasons beginners lose money is the lack of a structured review process. Trading is a performance activity, and like any performance-based discipline, improvement requires feedback. Without reviewing past decisions, there is no way to identify patterns, correct mistakes, or refine the approach. Beginners often focus entirely on the next trade. Once a trade is closed, whether it wins or loses, it is quickly forgotten. There is no analysis of what was done correctly, what could be improved, or whether the trade aligned with the strategy in the first place. This creates a situation where the same mistakes are repeated indefinitely. There is no learning loop, no progression, and no development of skill. Trading becomes a series of disconnected decisions rather than a structured process of improvement. Professional traders approach this very differently. Every trade is documented and reviewed. Patterns are identified, metrics are tracked, decisions are analyzed independently of outcomes. This creates a feedback loop that drives continuous improvement over time. Without this process, progress is largely accidental. With it, improvement becomes intentional, and this is where the transition begins, from reacting to the market to systematically developing the ability to operate within it. At this stage, a clear pattern begins to emerge. Beginners are not losing money because the market is unfair or unpredictable. They are losing because their behavior is unstructured, inconsistent, and driven by short-term thinking. And one of the most dangerous expressions of this is inconsistency in execution. A beginner may have rules, or at least an idea of what those rules should be, but they are not applied consistently. One trade is taken according to the plan, the next is taken impulsively. One trade respects risk limits, the next exceeds them. This inconsistency creates randomness in results, even if the underlying strategy has potential. The issue here is not knowledge. Most beginners understand at least conceptually, what they should be doing. They know they should manage risk, follow a plan, and remain disciplined. But knowing and executing are two very different things. Execution requires control under pressure, and that is where most traders fail. Consistency is what allows an edge to materialize. Without it, even a strong strategy becomes ineffective. Imagine applying a profitable system only half the time, while the other half is driven by emotion or impulse. The result is a distorted performance profile that does not reflect the true capability of the strategy. Professional traders are defined by their consistency, not because they never make mistakes, but because their baseline level of execution remains stable over time. Their process is repeatable, and that repeatability is what creates reliable outcomes. Another major reason beginners lose money is the misuse of leverage. Leverage is often marketed as a tool that amplifies opportunity, allowing traders to control larger positions with smaller amounts of capital. And while that is technically true, it is only one side of the equation. Leverage also amplifies risk, and without proper control, it accelerates losses just as quickly as it can amplify gains. Beginners are naturally drawn to the potential for higher returns. The idea of turning a small account into a large one in a short period of time is highly appealing. But this mindset leads to taking on more risk than the account can realistically handle. When leverage is used without a structured risk model, even small market movements can result in significant drawdowns. A trade that moves slightly against the position can cause a disproportionate loss, forcing the trader out of the market prematurely, or in some cases wiping out the account entirely. The problem is not leverage itself. Leverage is simply a tool. The problem is how it is used. Without strict position sizing rules and clearly defined risk limits, leverage becomes a liability rather than an advantage. Professional traders treat leverage with caution. They understand that survival in the market is the first priority. Growth comes later. And because of that, they use leverage in a controlled, calculated way that aligns with their overall risk management framework. There is also a critical misunderstanding around the concept of opportunity. Beginners tend to believe that the market is full of constant opportunities and that missing one trade is a significant loss. This creates urgency, and urgency leads to poor decision making. In reality, not all market movements represent opportunities. Most of what happens in the market is noise, random fluctuation that does not provide a meaningful edge. The challenge is not finding trades, but filtering out the vast majority of conditions that do not meet your criteria. Beginners struggle with this because they are not yet comfortable with inactivity. Sitting on the sidelines feels like doing nothing, and doing nothing feels unproductive. But in trading, inactivity is often the correct decision. This is where discipline becomes practical. It is not just about controlling emotions, but about having the clarity to recognize when no action is required. The ability to wait is just as important as the ability to act. Professional traders understand that opportunities are selective. They are defined by specific conditions, not by the mere presence of price movement, and because of that, they are willing to wait as long as necessary for those conditions to appear. This shift reduces the number of trades but increases their quality, and over time that improvement in quality is what drives consistency in performance. Another factor that contributes to beginner losses is the lack of alignment between expectations and reality. Many traders enter the market with unrealistic expectations about how quickly they can become profitable, how consistent their results should be, and how much they can earn. These expectations are often shaped by external influences, social media, marketing content, or anecdotal success stories that highlight extreme outcomes without showing the underlying process. As a result, beginners expect rapid progress and become frustrated when that progress does not materialize. This frustration leads to poor decisions. Strategies are abandoned too quickly. Risk is increased in an attempt to accelerate results, and discipline begins to break down. The focus shifts from long-term development to short-term performance. The reality is that trading is a skill that takes time to develop. It requires not just knowledge, but experience, repetition, and refinement. Progress is not linear. There will be periods of improvement, followed by setbacks, followed by further improvement. Professional traders accept this reality. They do not measure success over days or weeks, but over months and years. Their expectations are aligned with the nature of the process, and because of that, their behavior remains stable even when results fluctuate. Finally, one of the deeper reasons beginners lose money is the absence of identity as a trader. This may seem abstract, but it has very real consequences. Without a clear sense of how they operate, what they believe, and what their process is, beginners are easily influenced by external factors. They follow other traders, adopt ideas without fully understanding them, and change their approach based on recent information. This creates a fragmented style of trading, where there is no consistency in thinking or execution. Every decision becomes reactive. Instead of following a defined framework, the trader is constantly adjusting based on what they see, hear, or feel in the moment. This lack of identity leads to instability, and instability leads to losses. Professional traders operate differently. They have a clear framework that defines how they interact with the market. Their decisions are grounded in that framework, not in external noise. They may adapt over time, but those adaptations are deliberate and structured, not reactive. Developing this identity takes time. It comes from experience, from reviewing past decisions, and from refining a process that aligns with both the market and the individual. But without it, consistency is impossible, and without consistency, profitability cannot be achieved. At this point, it becomes clear that losing in trading is not random. It is structured, repeatable, and rooted in behavior. And if losses are structured, then so is the solution. The first step in avoiding these mistakes is not to find something new, but to remove what is already causing damage. Most beginners try to improve by adding complexity. They add more indicators, more strategies, more information, but this often makes the problem worse. It increases noise, creates confusion, and makes decision-making even more difficult under pressure. The real shift comes from simplification, stripping trading back to its core components: edge, risk management, and execution. Every decision should be grounded in these three elements. If a trade does not have a defined edge, it should not be taken. If the risk is not clearly controlled, it should not be taken. And if the execution cannot be repeated consistently, it should not be relied upon. This approach removes ambiguity. It creates clarity in decision making, which in turn reduces emotional interference. When the rules are clear, there is less room for hesitation, doubt, or impulse. Professional traders operate with this level of simplicity, not because trading is easy, but because complexity without structure leads to inconsistency. By focusing only on what matters, they eliminate a large percentage of the mistakes that beginners make. A key transition in becoming a disciplined trader is shifting from outcome-based thinking to process-based thinking. Beginners are naturally focused on results. They want to know how much they made, how many trades they won, and how quickly they are progressing. But this focus on outcomes is misleading. In the short term, outcomes are heavily influenced by randomness. A good decision can lead to a loss, and a poor decision can lead to a win. If behavior is adjusted based on these outcomes, it creates instability in the trading process. Process-based thinking changes the focus entirely. Instead of asking whether a trade was profitable, the question becomes whether it was executed correctly. Did it meet the criteria? Was the risk managed properly? Was the plan followed from start to finish? This shift creates consistency. It allows performance to be evaluated based on behavior rather than results. And over time, consistent behavior leads to consistent outcomes. Professional traders measure themselves in this way. They understand that profitability is a byproduct of disciplined execution, not something that can be forced in the short term. By focusing on process, they create the conditions under which profit becomes inevitable over a large sample of trades. Another important adjustment is the development of a structured trading plan. Without a plan, every decision must be made in real time under pressure with uncertainty. This is one of the most difficult environments in which to think clearly. A trading plan removes that burden. It defines exactly what conditions must be present before a trade is taken. It outlines how much risk is acceptable, where exits will occur, and how the trade will be managed as it develops. This pre-definition is critical. It moves decision making from a reactive state to a proactive one. Instead of trying to figure out what to do in the moment, the trader is simply executing a predefined set of rules. Beginners often resist this level of structure because it feels restrictive. There is a belief that flexibility is necessary to adapt to the market. But in reality, flexibility without structure leads to inconsistency. A plan does not remove adaptability. It provides a framework within which adaptability can occur in a controlled way. Professional traders rely heavily on their plans, not because they predict the market, but because they provide a consistent way to respond to it. And that consistency is what allows them to operate effectively over time. Risk management must then be placed at the center of everything, not as a secondary consideration, but as the primary focus. Every trade should begin with a clear understanding of the downside, not the upside. This means defining risk in precise terms. How much of the account is being exposed? Where is the exit point if the trade is wrong? Does this risk align with the overall strategy and long-term objectives? By answering these questions before entering a trade, the trader ensures that no single decision can cause significant damage. Losses become controlled, predictable, and manageable. This is where survival is secured, and survival is the foundation of profitability. Without it, there is no opportunity to improve, no opportunity to refine a strategy, and no opportunity to benefit from compounding over time. Beginners often underestimate the importance of this. They focus on making money first and protecting capital second. But the order must be reversed. Capital preservation comes first. Growth comes as a result of consistent, controlled risk-taking. Professional traders internalize this principle. They are not trying to maximize gains on any single trade. They are trying to manage risk across all trades. And by doing so, they create a stable foundation for long-term performance. Finally, consistency must be built through repetition and discipline. There is no shortcut to this. It is not something that can be learned once and then applied perfectly. It is developed over time through repeated execution of the same process. This is where many beginners lose patience. They expect improvement to happen quickly, but consistency requires practice. It requires making decisions the same way over and over again until that process becomes automatic. There will be mistakes along the way. There will be periods of frustration and doubt. But these are part of the development process. The key is not to avoid them, but to learn from them and continue refining the approach. Discipline is what holds this together. It is what ensures that the plan is followed, that risk is managed, and that decisions remain aligned with the strategy. Without discipline, knowledge is ineffective. With it, even a simple strategy can produce consistent results. This is where the transition begins, from reactive behavior to structured execution, from emotional decisions to disciplined processes, and from inconsistent outcomes to a stable, repeatable approach to trading. At a more advanced level, the difference between beginners and professionals becomes even clearer in how decisions are framed. Beginners tend to approach each trade as an isolated event. Professionals, on the other hand, view every trade as part of a broader distribution of outcomes. This shift is subtle, but it changes everything. When each trade is seen in isolation, the emotional weight of that single decision becomes very high. A loss feels significant, a win feels validating, and behavior begins to fluctuate based on those outcomes. But when trades are viewed as part of a larger sample, the importance of any one result diminishes. Professional traders think in terms of sequences. They understand that their edge plays out over dozens, sometimes hundreds of trades. Because of that, they are less concerned with individual outcomes and more focused on maintaining consistency across the entire sequence. This allows for emotional stability. A losing trade does not disrupt the process, and a winning trade does not create overconfidence. Both are simply data points within a larger framework. Beginners rarely operate this way. They assign too much meaning to each outcome, which leads to reactive behavior. By shifting perspective to a distribution-based mindset, the trader reduces emotional volatility and creates a more stable decision-making process. Another institutional level insight is the importance of asymmetric risk-reward. Beginners often think in terms of win rate. They want to be right as often as possible, believing that a high percentage of winning trades will lead to profitability. But this is not necessarily true. A trader can have a high win rate and still lose money if the losses are larger than the wins. What matters is the relationship between risk and reward, not just the frequency of winning. Professional traders focus on ensuring that their potential reward justifies the risk being taken. This creates asymmetry. Losses are kept small and controlled, while wins are allowed to exceed those losses over time. This does not mean every trade will have a large reward. It means that across the system, the average win is structured in a way that offsets the average loss. Combined with disciplined execution, this creates a positive expectancy. Beginners often reverse this. They take profits quickly out of fear, while allowing losses to expand in the hope of recovery. This creates a negative asymmetry that is difficult to overcome, regardless of how often they win. Understanding and applying asymmetric risk-reward is one of the key steps in transitioning from random outcomes to structured profitability. There is also a fundamental difference in how information is processed. Beginners tend to consume large amounts of information without a clear framework for filtering it. News, opinions, indicators, and external signals are all taken into account, often simultaneously. This creates confusion. When too many inputs are considered, decision-making becomes fragmented. Conflicting signals lead to hesitation, and hesitation leads to missed opportunities or poorly timed entries. Professional traders simplify this process. They operate within a defined framework that determines what information is relevant and what can be ignored. This reduces noise and allows for clearer decision making. The goal is not to know everything, but to know what matters within your specific approach. By limiting inputs to those that directly support the strategy, the trader reduces cognitive overload and improves consistency. This discipline in information processing is often overlooked, but it plays a significant role in performance. Clarity leads to better decisions, and better decisions lead to more consistent outcomes. Execution quality is another area where beginners lose money without realizing it. Even when a strategy is defined and understood, poor execution can undermine its effectiveness. Execution includes timing, order placement, adherence to rules, and the ability to follow through on decisions. Small deviations from the plan may seem insignificant, but over time they compound and distort results. For example, entering slightly late, exiting slightly early, or adjusting position size based on recent outcomes can all impact performance. These changes may not seem meaningful in isolation, but across many trades they create inconsistency. Professional traders place a high emphasis on execution precision. They understand that the strategy only works if it is applied correctly. This means following rules exactly as defined, without modification based on emotion or recent experience. Improving execution is often less about learning new concepts and more about refining behavior. It requires attention to detail, self-awareness, and a commitment to consistency. This is where discipline becomes measurable, not in theory, but in the ability to execute the same process repeatedly, regardless of external conditions. Finally, professionals operate with a clear understanding of risk at the portfolio level, not just the individual trade level. Beginners tend to evaluate each trade independently without considering how multiple positions interact with each other. This can lead to unintended exposure. For example, taking multiple trades that are highly correlated can effectively increase overall risk, even if each individual trade appears controlled. The result is a concentration of risk that can lead to larger drawdowns. Professional traders manage risk holistically. They consider how positions relate to each other, how much total exposure exists, and how different scenarios could impact the account as a whole. This broader perspective allows for better control. It ensures that risk remains within acceptable limits, even when multiple trades are active. Beginners rarely think this way. Their focus is narrow, centered on the immediate trade. Expanding that perspective is an important step in developing a more professional approach. By managing risk not just at the trade level, but at the system level, the trader creates a more robust and resilient framework, one that is capable of withstanding the variability of the market over time. Bringing all of this together into practical application begins with one simple shift: slowing down decision making. Most beginner mistakes happen in moments of urgency, where decisions are made quickly without full alignment to a structured process. The goal is to remove that urgency and replace it with deliberate, rule-based execution. Before entering any trade, there should be a pause, not a hesitation driven by fear, but a deliberate check against predefined criteria. Does this trade meet the conditions of the strategy? Is the risk clearly defined and acceptable? Is the position size consistent with the overall plan? If any of these questions cannot be answered with certainty, the trade should not be taken. This alone eliminates a large percentage of low-quality decisions. It shifts trading from reactive behavior to controlled execution. This process may feel slow at first, especially for those used to acting quickly, but over time it becomes natural. Decision making becomes clearer, more structured, and less influenced by emotion, and as a result, performance begins to stabilize. The next step is to standardize risk across all trades. This means removing subjectivity from position sizing and ensuring that every trade carries a consistent level of exposure relative to the account. Instead of increasing risk based on confidence or recent performance, risk should be fixed according to predefined rules. For example, risking a small consistent percentage of the account on each trade ensures that no single outcome can cause significant damage. This creates uniformity. Losses become manageable and the impact of any one trade is reduced. It also allows the strategy to play out over time without being disrupted by large, unpredictable drawdowns. Consistency in risk also supports psychological stability. When each trade carries a similar level of exposure, there is less emotional variation between outcomes. This makes it easier to remain disciplined and focused on execution. Beginners often resist this because it limits short-term upside, but in reality it protects long-term potential. It ensures that the account remains intact, allowing the trader to continue developing and refining their approach. Another practical adjustment is the implementation of a structured review system. Every trade should be recorded, not just in terms of profit or loss, but in terms of decision quality. This includes documenting the reasoning behind the trade, the conditions present at the time of entry, the risk parameters, and whether the plan was followed throughout the trade. Over time, this creates a dataset that can be analyzed for patterns. These patterns are where improvement comes from. Repeated mistakes become visible. Strengths can be identified and reinforced. Weaknesses can be addressed with targeted adjustments. Without this process, development is slow and inconsistent. With it, improvement becomes systematic. Each trade contributes to a growing body of knowledge that refines the overall approach. Professional traders rely heavily on this feedback loop. It allows them to evolve their strategies and improve execution over time. For beginners, implementing even a basic version of this process can significantly accelerate progress. Stepping back, the overarching lesson is that beginners do not lose money because trading is impossible. They lose money because they approach it without structure, without discipline, and without a clear understanding of how performance is actually generated. Every mistake discussed, overtrading, poor risk management, emotional decision making, lack of consistency, is avoidable, not through talent, but through process. By replacing reactive behavior with structured execution, the entire experience of trading begins to change. Losses do not disappear, but they become controlled. Decisions become clearer. Confidence is no longer based on outcomes, but on the ability to follow a defined plan. This is the turning point, where trading shifts from being unpredictable and frustrating to something that can be understood, managed, and improved over time. Ultimately, success in trading is not about finding a secret or discovering a perfect strategy. It is about removing the behaviors that cause failure and replacing them with a disciplined, repeatable process. The market will always be uncertain, there will always be risk, but within that uncertainty there is structure, and those who learn to operate within that structure with clarity and discipline are the ones who achieve consistency. If there is one takeaway from this entire video, it is this: focus on how decisions are made, not just on the outcomes they produce. Because over time, the quality of those decisions is what determines everything. And if this perspective is applied consistently, the question is no longer why beginners lose money. The question becomes how long it takes before that pattern is completely broken and replaced with a professional approach to trading. If this helped reshape the way trading is understood, make sure to like the video, share it with someone who needs to hear it, and subscribe for the rest of the professional trading video series.